Hello traders, James from Harvest. I want to show you in this video how to trade. Not just how to trade, but the three things you need to trade. And these are lessons I have learned over time while trading. And I believe it's something that will not just help you, but it will help you trade to profit. It has worked for me, and I believe it can work for you as well. You're going to have a good time trading, and it'll just be an eye opener for bigger things for you. I will go on with my slides now. You see this here, there, how to trade three things you need. Trend. I define trend as the angular direction of the market. So trend is just simply the angular direction of the market. And there are three types of trend. The first one is the uptrend. I believe you're very familiar with it. If you're familiar with charts, you know what uptrend is. And these are first of the few lessons that you get any trader gets to learn. Uptrend. So you see here, I used Apple as an example. That has been a very good company, and it has grown over time. So this is an uptrend. You see the angle moves slightly up. The angle of the market is just moving up in the upward direction. Let me say in the northeast direction. That is what I use for it, in the northeast direction. All right, that is the uptrend. Now the next is the downtrend. The downtrend. The downtrend is just the opposite of the uptrend. So it is moving in the southeast direction. Southeast direction. It is moving towards the southeastern direction, and that is just it. It is sloping downwards. So it is called the downtrend. So you must know what the trend is first, and then the third type of trend is the range. There's the range. The market is just indecisive. It is moving sinusoidal. And I'm going to quickly share with you few of this on real-time charts. You can detect the trend using the moving average, and also by using the lower highs and the higher highs. For the uptrend, you use higher highs. This is a high here. This is a higher high here. This is on the higher high, and then also you use higher lows for the uptrend. Higher lows. The lows are getting higher. Then for the downtrend, you can also use the lower highs. This is the high here, the lower high, a lower high, a lower high, downwards like that. Also you have the lower lows, you just keep going down. And then for the range, you just have everything stagnated in the same direction. You don't have highs, you don't have new lows, everything is just sinusoidal, and just like it's sine wave or cosine wave. Okay, now I'm going to go to real life charts now to see how moving averages can also assist in understanding trend. All right, I'm going to be using Tesla for my uptrend, and then you can see the slope moving up in the upward direction here. Well, it is not just about just moving up in the upward direction. It is about we having higher lows. So you may not quickly detect higher lows exactly, but with the different moving averages you can use, we have the short-term moving average, which are 5, 10, 20, 21, and so on. And then I also have the mid-term moving average, which are 50, 100, and the likes. Then I have the long-term moving average, which I use very well. I'm going to insert the 200 moving average now. You see how the 200 moving average is going to assist us to know when the trend is up and when the trend is down. When the market price is above the moving average, then it is an uptrend. You can see here it's all the downtrend. It's a downtrend here now. It's moved up above it, and the farther it is from the moving average, the better the trend is. You can see now it continues again, up till date, up to the making of the video. Yeah, you can see how the trend has just been in the upside of the moving average. So this is an example of how the moving average can assist the trend. Now for the downtrend, I have a 4 hours chart of Bitcoin, and I want to detect my trend now using the moving average, trend moving average. Here we have the uptrend. It's just actually ranging in this direction. It's ranged here, and then now we have the downtrend being carved out. You see how far the price is from the moving average. Here we still have it to the downside, and to the downside and to the downside. Now up to date we still have it to the downside. Now to the ranging market, I'm going to be bringing out my moving average now. We see how it has just been in the same direction, no up, no down. So uh, that is how a moving average can help the trend detection. We have taken trend, so I'm going to move on to the second point that you need to know before placing a trade. The second one is exits, and the note here says that note the plural nature of the exits. It is exits, so that means we have more than one exit. And in the trade, I think you're supposed to know that we have two exits. The types of exit we have: the stop loss, which is more important. I said I tagged this to be more important because your stop loss is naturally supposed to be lesser than your take profit. You're not supposed to be taking a trade that is going to give you a profit of $10 and also at the same time a loss of $10. No, that is not a good trade. The win rate is supposed to be higher than 1. That is your win loss ratio supposed to be higher than 1. You're supposed to be having a stop loss that is $10 and you want to win $100, you want to win $50. Yes, that is a good trade. So your take profit is also important. These two, you must not place a trade without having these two in view. You must have these two in view. There is no way, if you're a trader who places trades without having these two in view, whether being scalper or anything, market will crash you out. Market will crash you out. That is just it. I'm going to go to a trade now that I took some days before this recording, and the trade was an exciting one, but it actually made me almost cry. All right, here was the trade I took on this particular day. I entered here. It was a short trade. It was supposed to give me profit in this region. It was just 6 pips away from my profit. 6 pips away from my profit, and that is the power of exit. I calculated, maybe I over calculated, and just 6 pips away from my profit. And you can see how the market moved in my direction. It moved against me and crashed me out here, my stop loss. So that is the importance of stop loss, the power of stop loss. Assuming I didn't have stop loss here now, you can see how the trade will just continue to go up and might eventually liquidate my account. I felt bad losing this small amount of money here, but it helped me not to lose my whole account. It helped me not to lose my whole account, my entire account. So stop loss, take profit are very important. The take profit was not hit, but the stop loss was hit. So it was still a good one. Now after the second point, which is the exit, what is the third point? The third point is entry. Why entry? Okay, I said in my points that this is the reality of the trader. Yes, the entry is the reality of the trader. What I mean by this, it means this is what defines who the trader is. Here you will be able to differentiate between the starter, the intermediate, and the pro, the professional. And this is also the analysis, the fundamental analysis, technical analysis, the psychology of trading, the emotions, the maturity, and then the strategy, and so on. So entry is something that is very, very necessary, and it is valuable. I think entry is one of the, I won't say it is the most important of these three factors. Entry is very important and very necessary to know. So if entry is just all about all the lessons you need to learn in trading, the experience. So entry is going to make you know when to enter. When to enter. Please scroll down to one of the charts that we have earlier, and then to define how entry is so necessary. Let's imagine someone who wants to buy the stock now, and then the person entered around this region. You can see that from a little bit of overstretching, the person was buying at the high instead of at the low. So it is not so bad though, but he could have placed his stop loss around this region or this region and he would have been stopped out. It's good you have stop loss, but it's better to know where to enter. Better to know where to enter from. And why people enter wrongly most times is the fear of missing out. FOMO, the fear of missing out of the market, and then you just enter, you're dashing into the market, and that is the factor of emotion. emotion affects the person, and then you just enter the market anyhow without even thinking or blinking eyes. You have a plan before, but because you see the market moving and then you just jump in or just take a recap of everything that we have mentioned. We have the trend, the direction of the market, the angular direction of the market, and then we have the exit. The exit, that's your stop loss and your take profits, and then we have the entry. So these three factors I want to say is the most necessary things you need to know for placing a trade. Subscribe to our channel. You'll see more of details regarding these topics, and then you'll really be on the good side of the market. I wish you successful trading. All the best.